Welcome to the Furlough Capital Real Estate Podcast, where we dive into the intricacies of passive real estate investing. And our mission is to equip people to invest wisely in both properties and residences so that together we can build wealth while improving housing. I'm James, and this is my wife, Jessie.
I'm here, and we can officially start listening to Christmas music now.
Yes, that's your rule, huh?
That's my rule. After Thanksgiving. Although Eleanor wanted to learn some Christmas tunes on the piano, and so I had to make a little bit of exception, like hearing that, which I was like, okay, I understand. If you're performing, you have to learn some things ahead of time. You can't learn it last minute.
Yeah.
So,
all right, but we're here.
Soft.
We are in the just the whole
holiday
the
season.
Christmas holiday season.
The
Here
Christmas
it is.
Spirit.
Yeah. As people start ramping down, it's time for us to ramp up. So it's all good. I wanted to talk about how real estate can strengthen your overall overall investment plan. Yeah, and I wanted to start off by having you verbally describe this chart here.
It's pretty colors.
Yeah. So it's a 3-column chart.
Yes.
Comparing
different income levels. If your net worth is between 0 and almost $500,000.
Yep.
If it is, that's middle income.
If it's between $500,000 and
10 million ish,
and then
over 10 above 10 million.
Okay. And each column represents the percentage of where their wealth is invested. Okay?
Ew.
So
the columns going up says it could be invested in your principal residence, pension accounts,
how much is
liquid assets.
For people whose net worth is less than $500,000, what percentage of their income is in their
61.9% is in their principal residence.
Oh, that's a lot.
Crazy.
That
so
is crazy.
Half of your investments is your house. But your house doesn't give you any money unless you sell it.
Well, that's true. Same with stocks and bonds for the most part.
All right, interesting. And then pension accounts, like the job related, 401ks, and then liquid assets.
Yeah.
I don't know, 16.
Yeah. Okay. So then, how does that compare to people in that $500,000 to $10 million, which I think is where most people are going to sit who live in Oregon?
Okay. So the numbers start to break up a little bit. So their principal residence is 25% of their investments. Pensions is 22%.
Okay.
And then
so about half their income is their house and stocks and bonds. Or half their wealth, I should say.
Yeah, about half is,
Okay.
And then there's a few other things. Miscellaneous assets, stocks, securities, mutual funds, trusts.
What's that 18? Oh, okay, never mind.
Yeah, that's stocks.
Oh, so pension accounts are different than stocks.
I would imagine pension accounts are more like 401ks.
Yeah, maybe you're right. And then those are just
it has to be job
beyond.
related. This is like more of the
I think you're right.
Self-directed.
So if they've got 22% in pension accounts and then another 18%, so we're talking like 40% is invested in the stock market, paper assets, that
probably
kind of
about that. And then an additional
what's that,
24.5% in business equity and other real estate.
Okay. All right.
So they have diversified quite a bit more.
Yeah. So that means they probably got a rental or something like that. Maybe and rental if your primary home is 25% and your rental is 24%. That's probably you got a rental maybe too.
It's interesting to me that this middle column, it kind of evens out into these 4 big chunks.
Yeah.
It's like there's
very
my
diversified.
primary resident, my retirement types of things, additional investments in stocks, bonds, that type of thing, and then this business real estate area. But it's pretty evenly kind of split.
Yeah.
Between those 4.
Okay.
And then
which I think like that's most people who are listening. They fall into that category.
Sure. Yeah, it's kind of like okay.
Ours doesn't look like that, but that's where we fall.
Right. Yeah, it's okay. And then as your net worth goes up,
Yeah,
it
as
kind
you
of
get above
shifts
10 million,
more into this business and other real estate.
you actually have 50% of it is in business and real estate.
Right. And and about 80% of your wealth is investments.
Which makes sense. I mean, you can't.
Yeah. I mean, if you're making more money, but your living expenses are staying the same, like, you're going to put it somewhere.
Well, for the most part, a house is like, it's fixed, right? You can't. I mean, I guess you can go out
You
and
could buy a mansion.
$8 million house, but you probably don't.
Yeah. Most people probably don't.
Yeah.
Huh. Interesting.
What's interesting about it?
It is interesting, just the amount. It makes sense, like if your net worth is smaller, you don't have as much to invest or diversify in multiple different things. That middle column is the most interesting to me, because it's like you don't have a ton of wealth, but you don't. It's not the smallest, so you're not like, oh man, I'm gonna put
honestly,
it in my
if
house.
you got like $2 million, you're
Well, yeah,
way ahead of the
that's
curve on most people.
quite a bit.
So that's.
I'm thinking even of the lower end of that.
Oh, okay.
Yeah, the $500,000 marker.
Okay. So what I think this does a good job of is painting that picture of how real estate adds to the diversified portfolio plan. And what I really like to think about are 3 buckets of where you should be investing. And this is how, like, family offices, which are large investment groups, and how billionaires think about their investing. Again, there's 3 buckets. So the first bucket is that, really that first bucket is the direct investments. These are things that people are doing, like, they fund all the other buckets, really. And so it might be something like a business that they own or a job that they have, right? It's this thing you are working directly on it. You spend your time and energy focused on that, making it valuable, again, earning income or getting profits from it. And you have the most control out of it. And it is also really hard to liquidate as a general rule. Like, obviously, if you have a job, you can't sell the job. Right. You just get to quit.
It just ends.
And often if you have a business, like, sometimes finding a buyer for that business can be very difficult. But while you own it, the cash flow can be awesome. Does that kind of make sense?
Yeah.
That's that first bucket. And and so you got to have that part to some degree.
In that first bucket, are you always trading your time and energy for the income or the benefit that you're getting?
Yeah, you are. Whether that's a business or a job.
Right. You're involved somehow.
You are controlling it, which means you're putting your time and energy into it.
It's not passive whatsoever.
Correct.
Yeah.
Right. Now, it might be leveraged. Like, you might have employees, you might have other stuff.
Sure. But,
like, it's your main thing. The other bucket that a lot of people have is what they would call, like, the defensive portion of it. And the goal with this bucket is just to maintain your wealth. That's it. And so you have zero control over it, and the liquidity of it is very easy. And so examples of this are like stocks, bonds, that kind of thing, commodity. And this is the classic situation that you see most people have, right? Hey, you've got an awesome job, earn the money. Now take some of that, set it aside for the future, preserve your wealth, and you're doing it in something that is totally unrelated to you whatsoever, right? Like, you could do whatever you want, and that money's just going to do what it's going to do. And there's value in that, right? The issue with it is that it's defensive. And in some ways, your goal is like, I just want to keep up with what normal investments are making. That's about it. Like, as long as I beat inflation, I'm happy. That kind of thing. Again, the downside of it is there's nothing you can do to make it better or to improve it. It's just, it is what it is.
You're trusting someone else to manage it.
Yeah. And to be clear, like, you want to have some of that. Like, you don't want to forsake that part of the investment piece of it. Like, that's
is that because it's
unbalanced if you don't.
Stable or less risky or?
Yeah. I don't know if stable is the right word, but just less risky in the sense that it diversifies where your wealth is.
Okay.
Right? If you've got all your money, like, if all you have is a job And your wealth is just that income that comes in and you're spending all of it.
When it ends,
it's highly risky in the sense that when you lose your job or you retire, like you've got nothing.
Mm-hmm.
And so that's risky. Same. You maybe have a business and I don't know, man, a couple lean years, something happens, whatever, like boom, you're down. I mean, I've listened to enough entrepreneurship podcasts where they talk about how one of the mistakes they made was they built these businesses and they just kept reinvesting, and it grew a lot. And then something happened and they had never taken any chips off the table. And they just went, oh, what do I have to show for this? Nothing. I was like, no. And so they regularly okay, you gotta allocate some profit for yourself, even if it's a little bit, at least get into that habit of taking chips off the table, at least a little bit for it. Because there's no guarantee that business continues on.
Okay.
Yeah. So that's the idea. And it's super easy, right? It you can open up an IRA and say I'm automatically going to transfer money into it. You don't have to think about it. It doesn't take any of your time. You can still focus on the other areas of your life.
Makes sense.
And that's where a lot of people are. Yeah. And then they stop. They go, cool, done.
Good enough.
And there is also a middle ground there, a third bucket, if you will, and that is often cash flowing real estate. And what's cool about it is, at least for us, is you can use that to pay your living expenses, which is a cool idea to say, yep, I've got this business or this job that's generating the income. We talked a lot about this when we were getting started, generating this income, and then we're going to filter it into these other. We got one that's kind of a preserve our wealth, don't worry about it, and the other one where the whole goal is to pay for our living expenses. Yeah, that's it. And you don't have full control, but you have influence over it, especially if you're a passive investor. Like you can choose where you're going to invest in. You can vet sponsors, that kind of thing. The liquidity is often it's medium. Like you could sell a house, and that's, it's very possible. If you're part of a syndication, they have regular times of exits that happen. Again, it's a lot easier to sell than it is a business potentially, but not nearly as easy as selling some stocks. And so it's kind of this middle ground. And again, it's like big apartments, self-storage, offices, anything that you could invest either actively or passively in. And kind of depending on the route that you go, depends on how much time you have to learn the systems and, and learn how to invest it. Like if you're like, I don't have the time to do this or the expertise, cool. Like you should go down the passive route because you can still earn the income, you can still get a lot of the benefits, but you don't have to be that expert. Or you don't, or you're like, yeah, I still want to buy it, but I'm going to hire a property manager to run it all because they can do the day-to-day stuff and I can still sit at the higher level strategy side of my portfolio. And so that's one of the, I want to check my notes here to make sure. The cool part about real estate, unlike stocks as you observed or your primary home, is you often can get some cash flow from it while still owing it, holding it. You don't have to sell it to totally cash out, and that's just a huge perk in general. And so it's like your business or a job. You don't sell it or lose it. Like that's the only way that you get income. And then with stocks, typically the only way you get income is by selling it. And this is like, again, it's like nice little hybrid round. It really is the middle, and so that's how it can strengthen your plan. Because I think you can have a lot of people where they've got an awesome job, they're working hard, and they're putting all their money into preserving wealth. It's like cool, but they're not doing that middle ground of like, man, you could do just a little bit more work here and you can earn some extra returns to just accelerate that timeline for when you have the option to retire.
And is it kind of like you have your job and you're taking a portion of that income and putting it into these other two buckets? Do you I don't want to say this. Do you just take more out of that first bucket to put it into, like, let's say you have bucket 1 and bucket 2. Okay. And you're taking,
label them for me just so I know.
The one is your job, and you're working, you're trading your time for money, and you're taking that money and you're putting some of it into bucket 2, which is like this retirement account, stocks, bonds. Yep. And like, let's say I want to start doing a bucket 3. I'm like, well, I'm already like, do I take some of the money from my bucket 2 to start putting it over here? Or do I just have to like work harder and make more money and then put it over there?
I think oftentimes it's taking some from bucket 2 and moving it over there.
It's transferring some of that I allocated into my savings to do something different.
Yeah. I mean, there are some people who like they'll do a side hustle or whatever because they'll say, "Oh, I am not investing enough, and so I need to." And the problem is, I need to increase my income. I've talked to plenty of people where they're like, "Man, I just want to invest more." Like, cool, got to earn more.
Right, and that's going back to that graph that you showed me at the beginning.
Yeah.
I feel like that's one of the biggest differences between those three groups of people as well. You know, it's like the people in this lower or this middle income, their net worth is lower. They don't have as much to put into those investment buckets.
Correct.
And as your income increases, you get a side hustle, you get a different job, you get more expertise, whatever, you get higher pay, you have more to invest in those other spots. So
and
naturally kind of diversify.
So I think there are a lot of high income people who are investing as if they're low income.
Interesting.
Where they're just putting a lot of money into that defensive bucket only. And the opportunity is to say like, no, there's this other bucket here, this cash flow in real estate that you should be allocating some of your wealth to. I think that's the fundamental, because I 100% agree. Yeah. If you're low income, like, man, do what you can, save, awesome. Work on investing in yourself, right? Increase your skills, increase your value, increase your income.
Yeah.
That's probably your highest return on investment. But when you're already in that upper income, it's like, man, stop just putting it all into the stock market. That's fine. It will work eventually, but that's not necessarily the most diversified, the strongest way to grow your wealth.
Makes sense.
Yeah. So there you go.
Cool.
So that's what I wanted to talk about today. It's just it's a simple concept of like really just think about, and I love the visual of the three buckets.
Yeah, that was helpful to me.
Of where your time, attention, and money is coming, where your wealth is coming from. And so I find that super helpful for myself. And again, I think for you and I, we both started with jobs, and that was where we put a lot of our time and attention in. And we did do both buckets, but we were primarily like real estate bucket was like our big one. And then we did have some retirement one. And we now have a lot less retirement one. It's definitely less than 10%, I think, of our overall wealth. I think we're proportionally, we look like that ultra high wealth where it's like, we're not even, they're like at 49% business real estate. We're probably closer to like 80% real estate, which part of me is like, and I'll admit it's a hybrid too, right? Where I'm like, it's the direct business. It's where I spend my time and energy. Right. And it's also cash flow in real estate. And so that's one of the reasons why it's as big as it is. But yeah, and that's something I actually think about for myself. I'm like, oh, like that defensive bucket is not really existent for what we're doing. And that's an area where I'm like, okay, if I had a place to improve, that would be it. So we're in that opposite, like, the pendulum swung a lot on that. Again, I'm super comfortable with it. I know how it works. And so it's a lot less risky for me because I understand the system really well and I understand how the investing works, and that's okay.
And there's, like we've talked about in other episodes, there's a lot of diversification within that. That
also true.
Subsection. So it's like it is virtually impossible for that entire investment to blow up at once.
Got apartments.
Yeah.
Single family homes, storage, warehouses. Yeah. Rent by the room.
Yeah.
Like,
it's kind of.
My one chink in the armor is it's all within an hour of me. That's probably the one where I'm like, I don't love
fairly local
that part of it, but they are technically all different cities. They're just all near each other. Yeah. So, it's kind of just interesting thinking about like, all right, what are the best ways to allocate it? And so I would say if you're sitting in a situation where you are like, no, I've got some upper income, I'm sitting on some wealth, and if you do the math and you're like, man, I have a large proportion of it that is just sitting in stocks and bonds. That's where I might be like, it's worth having that conversation. Checking out our previous episode, talking about self-directed retirement accounts, saying like, okay, how do I allocate some more of this over to real estate? Not necessarily to make the big bucks and go crazy, but it's just part of that diversification process and just strengthening your portfolio. Cool. So there you go. And hopefully you found that helpful. If you did, we'd love to hear about it in the comments. And if you would like to learn more about investing with us, you can check us out at furlough.com. Thanks for listening and have a great day.